Imagine working for 40 years, building your retirement, saving consistently, doing everything right, and still losing hundreds of thousands of dollars to taxes. Not because the market crashed, not because you failed, not because of bad investments, simply because nobody ever showed you the right order. The order you withdraw money from your retirement accounts may be one of the most important financial decisions of your entire life. And almost nobody understands how powerful it really is. Because retirement is no longer just about building wealth. It's about protecting it from taxes, from timing, from mistakes that quietly compound for decades. And today, I want to show you the exact mistake most retirees make, why it becomes a disaster in their 70s, and the strategy smart retirees use instead. Because this single adjustment can literally save some people 6 figures over retirement. Not from higher returns, not from finding the perfect investment, but from sequencing. Here's the simplest way to understand this. Most retirees have 3 different buckets of money, and the IRS treats every single one differently. The first bucket is your traditional IRA or 401k. This is the account the IRS has been patiently waiting on for decades. Every dollar you pull out gets taxed as ordinary income, just like a paycheck. The second bucket is Roth money. The IRS already got paid on that years ago, which means every dollar you withdraw is yours. No taxes, no surprise bill, no government cut. And the third bucket is your taxable brokerage account. That one sits somewhere in the middle, usually taxed at lower capital gains rates. Now, here's where things get dangerous. Most people assume retirement taxes will automatically be lower. Sometimes they are. But many retirees are shocked when they realize they're still sitting in the 22% tax bracket, sometimes even higher. And every extra dollar pulled from the wrong account quietly leaks money. 22 cents gone, again and again, year after year. That's not a small inefficiency. That's an entirely different retirement. Now here's the advice most people hear. Spend taxable accounts first, then traditional IRA. Save the Roth for last. And honestly, that advice isn't wrong. It's just incomplete. Because here's what that strategy often creates. You arrive in your 70s with a massive traditional IRA, and suddenly the IRS forces withdrawals whether you need the money or not. At age 73, required minimum distributions begin. And this is where people get destroyed. Because those forced withdrawals can push you into higher tax brackets, increase your Medicare premiums, and make up to 85% of your Social Security taxable. All at the same time. And most retirees don't realize the trap until it's already too late to fix it. But there's a window, a very specific window, and most people completely waste it. Between retirement and the moment Social Security begins, there's often a gap. 5 years, sometimes 8, sometimes longer. And during that period, something unusual happens. Your income temporarily drops. You're no longer working. Social Security hasn't started. And required withdrawals haven't begun, which means your taxable income may be the lowest it will ever be again. That low-income window is one of the most powerful tax opportunities in retirement, and most people spend it doing absolutely nothing. The smartest retirees use that period for Roth conversions, and this is the part most advisors barely explain. Instead of waiting for the IRS to force future withdrawals, they intentionally move money from traditional IRAs into Roth accounts early, while taxes are still low. Yes, they voluntarily pay taxes now, but at a controlled rate, a lower rate, and the long-term effect can be massive. Smaller traditional IRA balances later, smaller required withdrawals later, lower taxable income later, which can also mean lower Medicare costs, less Social Security taxation, and more wealth preserved for family. Let me show you how powerful this becomes. Imagine two retirees. Same age, same investments, same $800,000 traditional IRA. The first retiree does nothing. The account keeps growing. And by age 73, required withdrawals begin on a much larger balance. Now they're suddenly forced to pull tens of thousands of taxable dollars every single year. The second retiree slowly converts $40,000 per year into a Roth during the low-income window. Carefully, strategically, staying inside lower tax brackets. After 4 years, they've quietly shifted $160,000 into tax-free territory. Future required withdrawals shrink. Future tax pressure shrinks. Future Medicare penalties shrink. Not because they invested better, because they planned better. That's the difference. And here's the crazy part. Some retirees actually end up paying more taxes retired than while working. Not because retirement failed, because tax planning never happened. Now, obviously, every situation is different. If you retired early and haven't started Social Security yet, this strategy becomes incredibly powerful. That gap may be the best tax planning opportunity of your life. If you're already collecting Social Security and your income is higher, the focus shifts toward carefully controlling taxable income. Sometimes that means leaning more heavily on Roth withdrawals, especially to avoid Medicare premium spikes. And if you're still working part-time in retirement, your earned income may already push you into higher tax brackets, which can make taxable brokerage withdrawals more efficient instead. But the real question is always the same. What withdrawal strategy creates the least tax damage this year, while also protecting future years? That question changes everything, because smart retirement planning is no longer about maximizing returns. It's about minimizing unnecessary loss. And before we finish, there's one final mistake that quietly destroys good plans. The market drops. Fear kicks in. Balances fall while you're still withdrawing money. And suddenly, people panic and start pulling from whichever account feels safest emotionally. That instinct is expensive. Because emotionally safe and tax efficient are rarely the same thing. One panic-driven year can undo a decade of careful sequencing. So here's the solution smart retirees use. Keep 12 to 24 months of living expenses in cash. Not for returns, not for growth, for stability. That cash buffer allows you to avoid touching investments during market declines, which means your withdrawal strategy stays intact when emotions are highest. And honestly, that peace of mind may be worth more than the interest you give up. Here's what I want you to remember. The traditional advice isn't necessarily bad. It's just incomplete. And incomplete retirement advice followed for 15 years can quietly create a tax disaster later in life. The smarter strategy uses the low-income window wisely, manages withdrawals intentionally, protects tax brackets, and avoids emotional decisions during market stress. Because retirement isn't won by the person who made the most, it's won by the person who lost the least. To taxes, to bad timing, to avoidable mistakes. And in the end, it's not just about how much wealth you build, it's about how much you actually keep. If this changed the way you think about retirement, accounts, let me know in the comments. Are you already planning withdrawals intentionally? Or is this the first time you've realized how important sequencing really is? Because most people spend their entire lives learning how to build wealth. Almost nobody learns how to keep it. Take care. See you in the next one.